In this lesson, we will learn about basic acquisition financing. To further understand acquisition financing, you need to examine the specific characteristics of different financial instruments used in M&A. Let's delve into how various financing options are prioritized, their maturity profiles, associated costs of capital, possibilities for amortization, and the specialization required in sourcing each type. Repayment priority. Repayment priority determines the order in which creditors are paid during a company's liquidation or bankruptcy. This hierarchy impacts the risk and return profile of different financing instruments. Order and rationale. Senior debt. At the top of the repayment hierarchy, senior debt is paid first because it is considered the least risky. This is usually secured debt, backed by collateral, thereby reducing the potential loss to the lender. Junior, mezzanine, debt. Paid after all senior debt obligations have been satisfied. Junior debt or mezzanine carries higher risk because it is less likely to be repaid in full in the event of a company's financial distress. Equity. Equity holders are at the bottom of the repayment ladder. They are the last to receive any returns and only after all creditors have been paid. Consequently, while equity carries the highest risk, it also offers the potential for higher returns as shareholders benefit directly from any increase in the company's value. Maturity increase. An investment risk increases from senior debt to equity. The maturity length of the instruments generally increases. It correlates with the level of risk investors are willing to accept. Order and rationale. Senior debt. It often has shorter maturities because of its lower risk and secured nature, allowing for quicker recovery of investment. Junior, mezzanine, debt. Maturities are longer than those of senior debt, reflecting increased risk and potentially higher returns. Equity. Typically has no fixed maturity as it represents a permanent investment in the company, reflecting its status as the most adaptable but highest risk option. Cost of capital increase. The cost of capital is the return that lenders or investors require to compensate them for the risk of their investment. It generally increases as the risk associated with the investment type increases. Order and rationale. Senior debt. It offers the lowest cost of capital due to its higher repayment priority and lower risk. Junior, mezzanine, debt. They carry a higher cost of capital compared to senior debt, reflecting their subordinate position in the repayment hierarchy. Equity. Equity demands the highest cost of capital, given the higher risk from its residual claim on assets and earnings. Impact of deteriorating repayment capacity. As a company's ability to repay its financing deteriorates, the impact on the recovery of principal varies significantly across different types of financing instruments. Order and rationale. Senior debt. This is typically the most protected in scenarios of financial distress. Given its secured nature and priority in the capital structure, recovery rates are generally higher. Junior, mezzanine, debt. This financing stands below senior debt in repayment priority and is often unsecured. As such, if the borrower's financial health worsens, mezzanine lenders face a significant reduction in principal recovery. Equity. Equity investors are the last to recover any funds in a distressed situation. As they are owners of the company rather than creditors, they may lose their entire investment in the worst scenario. Specialization of sourcing. Sourcing financial instruments for acquisition financing demands specialized knowledge of market conditions and the risk and return profiles of specific instruments. Order and rationale. Senior debt. This financing requires expertise in credit analysis, understanding of market interest rates. It also demands the ability to negotiate covenants, finding a balance between lenders' need for protection and the company's need for operational flexibility. Junior, mezzanine, debt. This financing often involves more complex negotiation of terms and potential kickers, equity-like features. Understanding a company's cash flow projections and risk tolerance is crucial. Equity. Finding suitable equity investors necessitates a strong grasp of valuation methodologies. It also involves the ability to articulate the acquisition's potential value creation and matching the opportunity with investors whose risk appetite and time horizon align with the investment.